Welcome back to the channel. Today we're diving deep into the biggest mistakes dividend investors make, mistakes that quietly eat away at your wealth over years, even decades. If you've been focusing only on income numbers or just picking ETFs because they look safe, this video is going to completely change your approach. Now, this isn't about making you feel bad or guilty about your portfolio. It's about spotting the subtle traps that most investors don't even realize exist, and learning how to fix them so your money can actually grow as it should. Let's jump in. This video is for informational purposes only and is not financial advice. Always do your own research or consult a professional before making any investment decisions. This is hands down one of the most common traps. People see a fund offering a higher yield and think, yes, that's more income for me. But this thinking can actually cost you a fortune. Take a look at some popular ETFs. VYM might give a 2.4% yield, while SCHD is around 3.8%. Your instinct says, go for SCHD, it pays more. But here's the kicker, yield is just part of the picture. Now consider DGRO. Its yield is just 2.1%, which seems low compared to SCHD. But over the last decade, DGRO has delivered an annualized total return of about 13%. VYM over the same period sits at around 11.3%. That difference doesn't seem huge until you calculate it on a $100,000 portfolio over 15 years. Suddenly, you're looking at a potential gap of $60,000 to $80,000. The lesson? Don't make investment decisions based solely on today's dividend payout. Price growth, dividend growth, and total return matter just as much, if not more, over the long term. One investor, Harry, learned this the hard way. He spent 3 years chasing high yields only to realize he'd left tens of thousands of dollars on the table. Takeaway: evaluate ETFs by total return potential, not just the yield your brokerage app displays. Expense ratios often seem trivial, a difference of 0.06% versus 0.2%. You might think it's just pennies, but compounding turns those pennies into real money over time. Here's an example. A $100,000 retirement portfolio growing at 8% annually will lose about $15,000 over 20 years simply because of that small expense difference. It's not the fee itself, it's how the fee reduces your compounding power year after year. Small drags add up. The good news, ETFs like SCHD, DGRO, VIG, and VYM charge between 0.05% and 0.08%. So you're mostly safe with those. But if you're holding older mutual funds or actively managed dividend funds, the expenses could quietly eat into your wealth. Takeaway: always check your expense ratios. If a fund charges more than 0.2%, question whether it's really worth it. Most of the time it isn't. Many investors think owning multiple dividend ETFs equals diversification. The reality? Not always. Here's the issue. The ETFs might overlap heavily in sectors. VIG's top sectors include technology, 30%, financials, 21%, and healthcare, 15%. DGRO is heavily weighted toward financial services. VYM tilts to financials and industrials, while SCHD recently shifted to energy as its largest sector. Now imagine owning all 4 ETFs thinking you're diversified. In reality, you might have massive overlap in just a few sectors. Top companies like Broadcom or JP Morgan can appear across multiple ETFs. So instead of spreading your risk across thousands of companies, you're effectively buying the same 50 or so companies multiple times, just with different weights. Takeaway: always pull up ETF holdings and check for sector or company overlap. Real diversification isn't just about the number of funds, it's about the companies inside them. Dividend reinvestment is a powerful tool, but it's not perfect. Most people set it and forget it. That seems fine, but there's a subtle drag at play. When an ETF pays dividends, it usually takes 4 to 8 business days for the money to actually buy new shares. During that period, your cash earns nothing while the market might be moving higher. In a rising market, this drip delay means you consistently buy shares at slightly inflated prices. Over decades, that tiny inefficiency can reduce your returns. Takeaway: either accept the delay as part of automation or manually reinvest dividends at strategic times, such as during market pullbacks. At the very least, understand the delay exists so you can plan accordingly. Taxes are one of the biggest hidden wealth destroyers. Placing the wrong assets in the wrong account can cost far more than a bad ETF choice. Qualified dividends from funds like VIG, DGRO, and VYM are usually taxed at a favorable rate, 0% to 20% depending on your bracket. But if you hold REITs, MLPs, or high-yield bonds in a taxable account, distributions might be taxed as ordinary income, potentially 37% for high earners. Harry made this mistake by keeping dividend ETFs in taxable accounts and growth funds in his Roth IRA. Logic seemed fine. Dividends now, growth later. But the result? Higher taxes and slower wealth accumulation. Takeaway: place tax-inefficient assets, REITs, bonds, in tax-advantaged accounts. Let qualified dividend ETFs stay in taxable accounts to take advantage of preferential tax treatment. This one adjustment can add thousands to your retirement nest egg. More ETFs doesn't always mean more safety. Many investors believe owning 7 or 8 dividend ETFs maximizes diversification, but it often creates complexity without reducing risk. Here's why. SCHD has 100 stocks, VIG 340, VYM 560, and DGRO 400. Owning all 4 doesn't mean you're holding Weshire's 400 unique companies. Many overlap. You're effectively tracking a blended index while paying multiple expense ratios. Academic research confirms that diversification benefits plateau around 30 to 50 uncorrelated holdings. Beyond that, you're just adding complexity. Takeaway: pick 2 ETFs that serve different purposes and stick with them. For example, one for dividend growth and one for high current income. Stop chasing maximum diversification. It's unnecessary and costly. This mistake is especially common among younger investors. People optimize for dividend income now when they should be prioritizing total return for long-term growth. Consider this. VIG yields 1.6%, but has delivered 13% annualized total returns over 10 years. SCHD yields 3.8%, but total returns hover around 11% over the same period. If you're 35 with 25 plus years to retirement, the higher total return wins, even if it produces less immediate income. Conversely, as retirement nears, shifting to higher-yielding funds makes sense to support living expenses. Harry learned this the hard way. His early 30s focused on high-income dividends felt great month to month, but by 40 he realized his portfolio grew slower than it would have if he had focused on total return. Takeaway: match your income strategy to your time horizon. Younger investors should prioritize growth. Those nearing retirement should focus on income. The investors who achieve real financial independence aren't the ones chasing the highest yield or juggling the most funds. They're the ones who eliminate hidden friction, like overlapping holdings and high expenses. Consider total return, not just dividend yield. Optimize asset location for tax efficiency. Match dividend strategy with their time horizon. Funds like VIG, DGRO, SCHD, and VYM are all excellent choices, but the key isn't which fund you pick. It's about removing the subtle drains on your portfolio so compounding can work in your favor, not against you. Audit your holdings, check your sector overlap, review your expenses, place assets in the right accounts, and most importantly, let time and compounding do their magic. If you follow these principles, your dividend portfolio will be much more powerful than simply chasing yield ever could. Thanks for watching. If you found this helpful, don't forget to like, subscribe, and hit the bell so you don't miss any updates. See you in the next video.